So yeah, we got this question from Steven on Atlas Engineered Products. So he says, Atlas Engineered Products, interested in your take on the company's balance sheet and how they are executing on their strategy of consolidating companies operating in their same business segment of engineered wood products. So Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of about $1.41 and a market cap of around 97 million. Now, the company designs, manufactures, and sells engineered roof trusses, floor trusses, and wall panels. The company also distributes a range of various engineered wood products for use by builders of residential and commercial wood framed buildings. And these include single family homes, townhouses, multi story wood framed residential buildings, commercial buildings, and agricultural structures. And the company's strategy is focused on profitability and organic revenue growth within its current markets, and the pursuit of a roll-up acquisition strategy to consolidate similar companies operating in the truss and engineered wood products industry across Canada. So I covered Atlas back in February of 2023. And at that time, my overhanging fear with the investment case was the comments from the CEO during our analyst call when he said that money being very cheap and interest rates going above 4% could potentially disrupt the business's growth. This is when, interest rates were below 4%, significantly below. But the stock has continued to, of course, climb approximately, 50%. Since I covered the stock last. So let's dig into what has taken place since. Now, looking at some operational updates, the company has made 8 acquisitions since going public in 2017, with the most recent acquisition in August of 2023 when it acquired Leon Chouinard, hopefully I'm saying that right, located in New Brunswick. And the company is a manufacturer of roof trusses, floor systems, and wall panels, and a supplier of engineered wood products. The focus of the acquisition is to grow the company's national footprint, and the company paid about $29 million with a price to earnings multiple of about 4.6 times earnings. Now, on June 26th, the company announced it closed a private placement for gross proceeds of about $14.5 million, issuing 10.7 million shares at a price of about $1.35 per share. And the company intends to use the net proceeds of the offering for the purchase and installation of robotic automation equipment at facilities located in BC, Ontario, and New Brunswick, along with additional equipment and upgrades required to incorporate the robotics at these locations. And following the private placement, I believe the company has approximately 69 million basic shares outstanding. So it is a little bit different than this graph that I have up on the screen, just because it actually hasn't hit the quarter yet, or the upcoming quarters yet. Now, this is kind of a nice segue into the next operational update, as on June 6th, the company announced that it accepted proposals for the installation of robotic automation equipment at 3 of its locations, and that it has made initial deposits to secure the installation of equipment. Now, the robotics installation is expected to have a total cost of just over US $7 million for all 3 locations, and the robotic automation is anticipated to double the board foot output of roof truss manufacturing while providing potential significant cost savings. Now, I saw an estimate from Cormark here, which placed the estimated robotics initiative to cost about 25 to 26 million Canadian over the next 2 years, with a new greenfield facility accounting for about 15 to 17 million, and the investments expected to increase truss manufacturing capacity at about 400% at High Tech. I believe they made that acquisition in 2022. 100% increase at LCF, which is the last acquisition they made that I just briefly went over, and 50% capacity increase at Clinton, with as well expected lower operating expenses and approximately 50% reduction in labor costs. And, like I said, the robotics upgrades are expected to be completed over the next 2 years. So Moving on to the recent financials, Q1 of 2024 being the most recent, revenue decreased about 5% to 9.1 million. This was primarily due to material price stabilization at a normal level, which was less than the two prior years, and a more competitive construction market created by interest rate hikes by the Bank of Canada. And the company does not anticipate that increased interest rates will affect sales long term. However, sales may continue to be affected in the short term as the market stabilizes and everyone waits to see if interest rates will be lowered by the Bank of Canada. Now, adjusted EBITDA was down to about 247,000 compared to 1.7 million for the same period last year, and net loss was a loss of about 993,000 or 2 cents per diluted share or basic share, I believe, compared to a gain of 543,000 or 1 cent per share for Q1 of 2023. And the decrease in adjusted EBITDA and net income was primarily due to lower revenues in a market with reduced housing demand and reduced gross margins due to the increased market competition and seasonality of the LCF acquisition over in the East. Now, looking at the balance sheet, they had about 7.2 million in cash with 30.9 million in debt and leases, providing a net debt position of about 23.7 million. And just remember, this does not include any cash from the recent equity raise. But I will say that the trailing net debt to EBITDA multiple has climbed as it was under 1 times as at February of 2023 when I looked at it, but is now up to about 3 times trailing EBITDA. Right now, I really think that the business is trading near fair value at over 40 times earnings, 15 times EBITDA, and about 28 times cash flow. But given the market is anticipating the recent investments to propel the financials over the next 2 years, and just for a reference point, in February of 2023, the stock was trading at about 6 times trailing earnings. But again, given these investments, it is looking like the financials and potentially earnings are going to grow over the next 2 years, if management can execute, of course. Just looking at the outlook here, management indicates that markets have been very competitive in 2023, and this is expected to be competitive in 2024, given, again, rising interest rates, which have affected the housing market and the company's near-term growth. But the company notes that it recognizes the need to be ready for a potential significant increase in demand if interest rates decrease during 2024, given the number of homes still needed to be built to support Canada's population growth. Now, to conclude, so I guess the first question is why has the stock continued to climb despite its weaker financial results? Well, number one, I would say, is due to the increased sentiment from capacity expansion, utilizing robotics and the ability to reduce costs. And I would say number two is increased sentiment just because of the shortage of Canadian homes, as there definitely needs to be a significant increase to meet the population growth in Canada. Now, fundamentally, the business remains pricey on trailing numbers, but if over the next couple of years it can fulfill its capacity enhancements and lower costs, the forward financials and valuation multiples will appear much better. Now, overall, I think that Atlas is a good business. Debt may be getting a little elevated, but I don't think that it's crazy. But even if it is unable to grow in its current markets as well, it will have the additional capacity to expand geographically. And whether I think that it's a buy, sell, or hold, I think it really comes down to whether an investor believes that Atlas will be able to fulfill their new upcoming capacity and capitalize on the potential cost savings, which could grow earnings over the next few years. But just like Hattie had said to us, that's the CEO, previously, elevated interest rates could disrupt the company's near-term growth, which of course appears to be transpiring. And we don't know how long this will last. Of course, interest rates, we were anticipating them to go down, but we'll see. So, generally, I think that it will be worth it to jump on a call with management to kind of get some more insight on the potential cost savings, strategy, and ability to fulfill their capacity that they're adding, and for us to get more color on the current market environment given the elevated interest rates. So yeah, I'll reach out. We'll get on a call with them, and we'll update our clients.
Yeah, I mean, we think Atlas is an interesting story. I think you did a good summary there. The long term
Hmm.
sentiment, the need for Canadian housing is there for sure. But I would be worried in the short term. I mean, the markets right now overall are pretty buoyant across the board. Small caps have started to be recognized. So, I mean, Atlas is kind of getting a benefit of the doubt right here in the current market climate.
Yeah.
Current fundamentals might not justify the current price. People are betting on the future. If the market were to shift, I don't know if I would be wanting to hold a company that in the near term faces macro headwinds and is expanding in that environment, has increased debt, and cash flows are lower. The market, if it is negative sentiment overall, can look negatively on a company like that in the short term, and it can happen fast, right? So, typically, we are wanting to combine good current fundamentals with the prospects of future. I think there's good prospects in the future here, and I think the company is
Yeah.
doing a lot of interesting things that could position it well. But is there some risk in the short term if you get a poor overall market sentiment? Yes, I would say based on the debt levels and the recent quarters, for
Yeah.
example, where you have lower results year over year, and no sign of that changing short term.
Hmm.
So yeah, I think if there was negative sentiment in the markets, you could get a cheaper price. I'd just be waiting on the sidelines right now. But it's done while the share price,
Yeah.
the last
Yeah, I mean,
quarter
it's
didn't look
not
too good.
like at the end of the day, the company's not worth 47 times earnings. So people are betting that earnings are going to be
Yeah,
going up significantly over the next couple of years. Now, that may happen. I think that there's good likelihood, as you guys have noted, but you know, all of that, like a lot of that is already factored into the price, obviously, because the current
yeah,
fundamentals are lackluster, right?
Yeah.
It really comes down to, well, what is the future growth? And now you're already paying for some of the future growth without even really knowing for sure what it is. I mean, the best opportunity is when you find companies with future growth, whereby that's not yet factored into the price. And, you know, that's not easy to do, but that certainly, there are opportunities that pop up where at least not so much of it is factored into the current price.
yeah,
Interesting company though.
Yeah,
yep,
just to give a bit of context on the pricing is for 2023 they had 10.5 million in labor costs. If you take half of that, like they were saying, 50% labor costs, that's 5.25 million in savings, which ends up about 4 million after tax, which puts it about a 13 PE. So just the
So that
savings,
that would be reasonable.
yeah,
So
and that's
Yeah.
reasonable
But
expectation.
again, that's the thing. Can they fulfill the
Can they
capacity?
do it?
Can
And
they,
that's what you're risking.
yeah.
yeah,
Exactly. And that's why I think that it's worth, reaching out, jumping on a call. I mean, Hattie has always been a very straight shooter from what I remember. I mean, again, even in his, what could derail the story? Well, near term growth, if interest rates go above 4%, well, it's exactly what happened. I mean, despite the stock continuing to rally, but, he's always been a pretty straight shooter with us when we jump on the phone, which is good.